This video will describe the contents of the Lender's Report, one of 6 reports provided by the Fiscal CheckUp software. The focus of this report is to provide a single report that will meet the annual financial reporting requirements for most lenders. This report should also give business managers an insight on how lenders view their business. The first page is a dashboard of 8 of the most important variables when evaluating the fiscal health of a business. This page is also included in the executive summary and industry comparable reports. The first graph compares the profit margins for the company compared to their industry for the past several years. Related charts and information can be found in the Industry Comparables report. The growth rate and the sustainable growth rate are always shown. If the question regarding sales price increases was answered, then a third line, the real sales growth, is also shown. The real sales growth represents the actual growth rate of the company after adjusting for price and cost of goods sold changes. The sustainable growth rate is the maximum growth rate that can be supported by the company's assets. Any growth above the sustainable growth rate over the long term would require external financing. More information can be found in the Profit Driver Report. This chart shows how the profits are different from the new or incremental sales and the old or base sales. The basis for calculating these values is explained in the Profit Driver Report, but it's critical to understand the profitability of new versus old sales. The values listed on this report are calculated only using the capitalization of earnings method. In the Valuation Report, 5 different valuation methods are calculated along with a blended value. A cross-check to confirm the blended value is also documented. See the Valuation Report for more information. The operating profit is the amount of money after cost of goods sold and operating expenses have been deducted from revenue, but before non-operating expenses have been deducted. Operating cash is the amount of cash from operations before other non-operating expenses. The 2 lines in this chart should be tracking together. When they don't, or there are wide variations, it's prudent to work with your CPA or business advisor to understand the reasons. For more information, see the Profit Driver Report. This is simply a ratio of the amount of debt divided by the amount of equity on the balance sheet. This ratio varies by industry, so both the company data and the industry comparable data are presented. Additional debt is not necessarily a bad thing as long as the net profit margin is greater than the interest rate on the debt. These forward-looking estimates assume the company continues to grow at its current rate and assuming other costs remain proportionate. This correlates to the projected cash flow statement later in this lender's report. The projected debt capacity shows the total borrowing capacity of the company for the next 3 years. These amounts are detailed later in this lender's report. Page 2 presents the income statement. In addition to the standard income statement breakouts of sales, expenses, non-operating expenses, and profits, this page also lists other data important to lenders, such as owner's excess compensation, operating income and its percentage, as well as EBITDA and total owner's earnings. On the bottom of this page is a table showing the year-to-year changes for the primary income statement categories. Page 3 presents the balance sheet, as well as a table showing the year-to-year changes for the primary balance sheet categories. Page 4 shows a cash flow analysis that is compliant with UCA, or Uniform Credit Analysis Standards, which is traditionally used by lenders. Page 5 projects the company's financial data for the next 3 years. This table of data was also included in the Executive Summary Report. Whether the calculations are made using the company's historic percentages or based on data supplied by the user, it is noted above the table. The cash flow projections on this page shows projected EBITDA and the cash surplus or deficit for the next 3 years. If these numbers are negative, it's likely the company will need to secure external sources of cash to fund the company. The next several lines show the borrowing capacity based on current assets and the borrowing capacity of net fixed assets. The total borrowing capacity is listed on line 23. As a reference check, the current debt as a percentage of the total borrowing capacity shows how close the company is to exceeding their credit capacity. Finally, line 29 shows the debt service coverage ratio, which needs to be above 1.25 in order to secure lender financing in most instances. Page 6 contains a listing of the ratios important to most lenders. This is followed by a table showing the cash conversion cycle, which was explained in detail in the cash driver report. On the bottom of page 6 is a brief discussion of the company performance based on the data presented above. Page 7 provides industry comparables. The latest year of industry values are provided to compare to the performance of the company for the last 3 years. This table shows data from the income statement, balance sheet, and other important ratios. Page 8 provides a profitability and working capital analysis similar to the one included in the profit driver report, but this one covers 2 years and goes into more depth. This analysis is performed to understand the real profitability of the change in sales, as well as the amount of working capital that was consumed to generate the change in sales. It starts with the sales and the change in sales from the prior year. For the gross profit, it separates the total change in gross profit into the portion that was due to a change in ratios from the portion that was due to the increase in sales. Similarly, for operating expenses, it separates the total change into the portion that was due to a change in ratios from the portion that was due to an increase in sales. Finally, we can see the actual profitability of the new sales, separated from the profitability that resulted solely from a change in the ratios. The same analysis is completed for the balance sheet accounts of receivables, inventory, and payables. We can separate the total working capital changes into the portion attributable solely from the change in ratios versus the amount of working capital that was needed to generate the change in sales. The difference between the profit from new sales and the working capital needed to generate the new sales is the total amount of cash that was needed to fund the change in sales. Page 9 contains a methodology for an objective risk rating. Lenders use an objective risk rating system to evaluate commercial loan applicants. Although lenders develop their own system, most or all of the variables they use are presented on this page. For each variable, we list the values for the company for the past 3 years, along with the latest industry average. Each variable listed in the table has a corresponding explanation below the table. In order to help the company understand how they compare to the industry, Fiscal CheckUp gives a rating for each variable. If the company would achieve the exact industry ratio, the rating score would be a 6. Scores below a 6 are below the industry average. Scores above a 6 are above the industry average. 10 is the top score for any variable. When looking at multiple variables, most lenders have a different weight for each component of their objective risk ratings. So Fiscal CheckUp has applied the weighting to the company's variance from the industry average and comes up with an overall value. Again, values above 6 mean that for these variables, on average, the company is performing better than the industry. Values below 6 means the company is performing below the industry. Within the more detailed explanations below, if the company is performing more than 10% above the industry, it's highlighted in green. If the company is more than 10% below the industry, it's highlighted in red. and if the company's within 10% of the industry average, it is in black. Realize the lender will have their own system. This presentation is simply an introduction to the objective risk rating concept and how lenders evaluate the loan risk of companies. The final page introduces the Fiscal Advantage V or viability rating and provides an overview to the company's competitive landscape and industry comparables. The V rating analyzes 7 different factors that have been shown to influence future viability. For each factor, the company is rated as to how the most recent fiscal year compares to their own trend over the past several years, listed in the column Compared to Trend. The second column, Compared to Industry, compares the most recent fiscal year to others in their industry. The final score to the right of each factor is the average of the two values. The profit gap variance calculates the additional profits a company could realize after considering the profits the company could achieve had they operated at their optimal level. This concept was explained in detail in the executive summary video. The higher the rating, the better and more consistent the company's performance. Since Fiscal CheckUp does not have this data for the industry, it is not part of the final score for this variable. The market and company dynamics factor utilizes 5 of the most important questions from the questionnaire, which were likely to predict future viability, such as market share and competitiveness of your products. The V rating provides an estimate of the future viability of the company. Note that this is a full 1 to 100 scale. An average or satisfactory company will receive a rating of 50 plus or minus 10%. If the question section was completed as part of the input wizard, there will be a narrative discussion on the bottom of this page regarding the competitive landscape and industry comparables. For each report, there is the ability for the user or business advisor to add comments. If any were entered, they are listed on this final page of the report. Thank you for watching this video. If you have any questions or suggestions, please call or email us.